What is going on, guys? Sir Lewis here, the YouTuber that helps you invest to rest. And in today's video, I'm going to be showing you guys how to do the wheel strategy using only $1,500, $1,500. Now, obviously, you can still do this with $500 or in 2K or even more, but I feel like this is the sweet spot, and it's a pretty good amount to start with. There's a pretty good amount of stocks out there that are good at this price range that I will be showing you today as I do this with you and show you guys how to do this strategy with the wheel strategy. Now, before I even start this, I'm just going to say that this video is for entertainment purpose only. I'm not a financial advisor, so do your due diligence and research a lot before you do this. So if you guys don't even know, the wheel strategy is really simple. You're basically selling a covered put, and what that basically is, let's say you want to buy a stock but it's at $16. Well, okay, I'm gonna buy it at $13. You can actually get paid for buying a contract that you can buy at $13 if it's currently at $16. It's called selling a covered put. So you buy that, you sell the covered put, okay, for $13. Obviously, you got to have the amount to be able to do that, which is $13 times 100 of those shares, because you're buying 100 shares. And then but on top of that, you're gonna get a premium paid to you automatically. You're gonna get that premium into your account. So either way, you're still gonna get that premium. So this is an awesome way to make extra money. Now, what happens is, for that expiration date, when you buy that contract, if that stock falls down to 13, right, or even lower, now you're buying it at that price, 13. Doesn't matter how low it goes, you're gonna buy it at that price that you set it for, but you still keep the premium, and now you own all those 100 shares of that stock at that price. But the good thing is, if it doesn't drop all the way to 13, you just keep the premium, which is basically free money at that expiration date if it's above 13. So then after you do that, what is part of the wheel strategy, like it's like a wheel that keeps on turning. So you keep doing that strategy over and over, and then one day you're finally gonna buy those stocks. It's finally gonna come down and you're gonna get those stocks. And then once you have those stocks, right, you're gonna want to sell a covered call. And when you sell a covered call, you're basically selling that stock, but you're putting it at a price higher. So let's say you have the stock, it's at 16. All right, I want to sell the stock at $18, right? So you can actually get paid just like selling the covered put. So you'll get paid a premium to set it for selling it at a higher price for a specific expiration date. I recommend doing it weekly because it's just more easy to manage and it's more aggressive. So then what happens is, when it gets to that expiration date and it's above that price that you sold it for, doesn't matter how much more it goes up, you're gonna sell it for that price and you keep the premium. Now, if it doesn't get to that price, you basically still keep the premium and you keep your shares. So the wheel strategy is pretty popular here on YouTube, and it's really gotten popular with just being able to get, you know, that premium, and it's really awesome. And in today's video, I'm going to show you guys how to do this with only $1,500, $1,500, which in my opinion is a great amount to start with. Because there's a pretty good amount of stocks out there. Obviously, the lower you go, the less the premium will be, right? So let's get started. I'm going to show you guys here the stocks that I recommend. Again, I'm not a financial advisor. This is for entertainment purpose only. So right here, as you guys can see, I'm using the app Webull, which I recommend. It's definitely the best app. If you want to use Webull, you can use my referral link and get 2 free stocks. Now, you can still do this. You can still follow along using Robinhood or another type of app out there. The options will still be the same. All right, so let's get started. All right, so you got $1,500 and you want to start doing the wheel strategy. Okay, this is the video to watch, and I'm going to be showing you guys how. So these are just some of the stocks that I have here as examples. All right, I'm not telling you to buy these, obviously do your research, but I'm just going to give you guys an example here. So your price range for the stocks is going to be $15 lower. All right, so as long as it's $15 lower, you can afford to do the wheel strategy for that stock. So first off, there's many types of stocks. There's dividend stocks, there's growth stocks, it all depends on your risk and your style, all right, of investing. So For example, let me give you guys an example here. This one right here is a dividend stock. It's called KMI, and they have a pretty good dividend yield, as you guys can see right here. With this dividend yield, for only 100 shares of this stock, you'll probably get $100 yearly. All right. Obviously, it can change here and there, but just owning 100 shares of this stock will give you guys $25 quarterly, which is $100 yearly. So a lot of people like to do the wheel strategy with dividend stocks, which in my opinion is more conservative, because yes, you get the dividends, but when you do it, when you start the wheel strategy, you want to start with the puts, and you want to sell a put. So the current price right here is $15, and you're currently looking to buy it lower than $15. So let's say right here, okay, I'll buy it for 14.5, right? So what you want to do next is you want to change it from buy to sell. All right. After you change it from buy to sell, you're going to press right here. And right here on Webull, it tells you how much premium you will get. I don't know if it shows on Robinhood, but right here, it tells you right here. So it's estimated premium $3. Only $3, all right? So as you guys can see, dividend stocks, yes, they give you dividends, but they offer a very low premium. Why? Because it's less volatile. All right, the price for this stock is usually not taking major dips or having major growth, which then gives you less premium. So you can take that route, obviously, if you're more into the dividends and you're less of a risk taker. If you're more into the dividends and you want to, do it safely, or you can do some research and try to see a growth stock that's scoring pretty good around that price range. And at this moment right now, I do recommend this one right here. Obviously, do your research, but this is a great stock right here that's been growing over the last days. Obviously, if you watch this video, it could be a lot more in that time. But this stock right here is called UAVS, and it's been growing. It's obviously a growth stock. So like I said, do your research, find a growth stock, and then let me just show you guys here the comparison. So this stock is currently 14.82 cents. We're gonna go right here to the closest expiration date, and all right, I want to buy it at 12.5. Obviously, there's a huge gap from 15, but let's just show right here 12.5. You're gonna press sell. It's gonna be $10, as you guys can see, which is a lot more. But let me just show you guys here. So it's currently at 14.82, and it's a growth stock, so it might take a huge growth this week and go to 16 or even 17. So if I go right here and I go above the price that it's in right now, which is 15, which isn't that bad. All right, let's look at the premium. So the premium goes to $105. $105 right there, guys, free. So, but the thing is, if I buy this, right, and by the time it gets the expiration date and it's below $15, no matter what the price is, you're still gonna buy this for this amount of price right here, which it tells you right here. So it's $1,395, which isn't that bad. And obviously, you want to do this for a stock that you really want to own. Like for me, I really like this stock. I believe in it. It will grow in the future. So even if I buy this, if this expires and I have to buy this, I'm gonna be fine, because I believe that this will probably grow in the future because it's a growth stock and I believe in the company. Now, what's awesome is, let's say the stock you buy that and then the stock goes above it. It goes to 16, 17. Well, guess what? You keep the premium, so you keep $105, right? So that's the huge difference between the dividend stocks for the wheel strategy versus the growth stock that's been growing for the last couple months or days, because it's more volatile. It's going to give you a higher premium. So that's one amazing thing to note. Now let's pick another one here. Let's look at Denny's, which is currently trading at 16.43. Let's go to options. Let's see how this one's doing. Alright, obviously has the same as the other one. So let's click right here at 15, which is actually under. So if it were to expire today, you would just get the premium. You wouldn't buy it because it's above 15. And as you guys can see right here, the premium is $15, which is not that bad. And if it drops below 15, then you're gonna buy this 100 shares of Denny's for 1,485, which is around 1,500. So you can do a lot of research here around this price limit, which is $15. Let's look at this one right here, SOS, which has been pretty popular in the last few days. So this one is obviously going to be more volatile, which is going to give you more reward. Currently right now it's at 11, but it's pre-market 13. But let's just look at right here. So based on the 11, let's say I want to buy it at 10, right? Look how awesome this is, right? So I want to buy it at 10, $75. You guys see that? Like it's trading at, let's look at here, it's trading at $11. In the pre-market it went to 13. So obviously when the market goes live, it's gonna get lower, the premium. So then it just shows you that the more volatile the stock is, the more premium you get, because there's more risk in it. So let's say, all right, I'll buy this if it expires at $10. All right, and most likely it won't expire this week at $10. It'll probably be a lot more, and you get $75, right? If you, either way, you will get $75, even if it expires or not. But if it doesn't expire below $10 or at $10, you're just gonna keep the 75. If it expires below it, then you're gonna have to pay right here $925 to have 100 shares of SOS. So like I said again, guys, make sure you want to buy, make sure you do this with stocks that you want to buy. All right, if it's a stock that you kind of don't want to buy but you still want to try it, then I would recommend to put it lower. Let's say for example, I don't want to buy this stock, all right, but I still want to do this, so I'll just put it a little lower, which probably won't go to that point unless it crashes. And right here, $15. So it's basically $15 free, because it most likely won't. Obviously you got to do your research and see the probability of it reaching that point in a week's worth, and you can make a lot of money using this strategy. So as you guys can see, that's basically how you do the wheel strategy with your price range at 1,500, which in my opinion is a pretty good price range, because there's a lot of growth stocks out there that are around below $15, right, that are trading options. You just got to do your research. Like I said again, UAVS is a great one that I've been researching, and it's trading about $15, and most likely it's going to reach to $20, or what I mean. So do your research, find a stock that you like, a growth stock that you like that's around this price range, and then you can start doing the wheel strategy at $1,500. And yeah, if you guys want to see more videos like this at different price ranges, I could do one at 500, I could do one at 2K. Just leave a comment, leave a like, and let me know what you guys want to see, and I definitely will. Sign up on Webull. I definitely recommend it, the best one, the best app to invest. Use my referral link to get 2 free stocks. And yeah, thank you guys so much for watching, and I'll catch you guys in the next one. Peace.